Thank you for that generous introduction, Evan. Hello, everyone. It's really great to be here again at another edition of Minds and Machines. My previous two presentations in 2023 and in 2024 have dealt with using machine learning and personality science to generate behavioral insights. But I think perhaps the most pressing question is, what do we actually do with these insights? In my experience working with financial advisors, one of the biggest challenges in getting the adoption of behavioral diagnosis tools is simply that they're seen as creating a friction cost. In other words, more stuff to do in an increasingly regulated process. Added to this is sometimes a lack of confidence in the application of these outputs. So if my client is anxious or overconfident, what should I actually do? What should my next interaction with this client look like? How should my advice or communication strategy actually change? The question is, therefore, how can we reduce this friction? The simple answer is that AI can help us in understanding and answering these questions. Now, decades of research into personality science, money attitudes, and risk behavior are already available to financial advisors via large language models like Claude or ChatGPT that we use every day. But financial services providers also have a ton of behavioral data on their clients as well that these large language models don't have access to. Momentum has data from our health screening app, for example, called Kimi. We also have behavioral archetype data we've studied that shows the behavior tax occurs in different clusters. Different behavior patterns are destroying more or less value. We also understand unique features that predict an investment switch and the exact point of sensitivity in predicting that switch. For example, we know that a client's portfolio value is not that important in predicting a switch, but as it gets up to about 300,000 Rand or $17,000, portfolio size becomes very important. At this point, we should start engaging with that client. We also should have a look at trading data from our stock brokerage, for example, that shows that Gen X segments suffer from the biggest disposition effect, which is a combination of regret aversion and loss aversion. Finally, the Momentum Money Fingerprint is now also in pilot phase. This is already shown to reveal the money attitudes and personality traits to successfully predict early pension withdrawals, or what we call the two-pot system withdrawals in South Africa. This is a big finding for us simply because in totality, the industry has seen approximately 60 billion Rand in withdrawals already. Perhaps unsurprisingly, the average income tax paid for these withdrawals shows that it's people in higher income brackets who are actually dipping into their pensions. Large language models are great, but when combined with this contextual customer data, this is where the magic really happens. Hyper-personalized context is more easily generated, making the financial advisor's life much easier and dramatically reducing any friction to applying behavioral insights in their day-to-day practices. Today, I'll show a working prototype of what this could look like using something called Retrieval Augmentation Generation, or RAGs for short. Let's begin with some of the basics. Think of traditional LLMs like ChatGPT as incredibly well-bred academics with near-perfect recall of everything they've learned during their training. The problem, though, is that their knowledge is generic and is not specific to a client's context, and they don't have access to the localized knowledge bases we mentioned earlier. The RAG is basically a supplement that can add to the base LLM's knowledge and find the most relevant piece of information to add to the response generated by the base LLM. This is now specific and relevant to a client. A RAG adds three important components. First, the knowledge base. Momentum has a term called behavior tax, and this calculates an annualized value comparing the performance of an investment a client left or switched out of against the future performance of an investment they switched into. There are many ways to quantify this, but this is our way of doing it. This is knowledge specific to Momentum, as all the investments for our clients are on a platform called Momentum Wealth, which sits inside Momentum. The point is, this is our own methodology, and so we need the AI to understand what behavior tax means and what it means in our specific context. We have added this specific knowledge base to our RAG prototype so it understands this context, for example. Second, the retrieval system. You can think of this as a smart librarian. When you ask a question, it doesn't just randomly search through everything. Instead, it uses sophisticated algorithms to find the most relevant pieces of information from the knowledge base. We'll go through a knowledge graph architecture soon, as this is particularly effective in making important links between concepts that reduce search and generation times. Lastly, the generation component. This is really where the magic happens. The base LLM like Claude or ChatGPT takes your question, combines it with the retrieved information from the bespoke knowledge base, and then generates a response that is both contextually relevant and factually grounded. The result? hyper-personalized content relevant to the financial advisor and their client's situation and needs updated in real time. Before we go on, let's run through a practical example to land these concepts. Suppose you're a financial advisor and on opening your client dashboard, you see that a particular client has a high disposition effect. And you'd like to know what product you should recommend in this specific situation to counteract this psychological effect. This is a query. You may phrase this as, what product should I recommend if this client has a high disposition effect? We'll show this in a live example later, but for now I'll run you through what is happening in the background. The first step is the query processing. The RAG analyzes the question and will break it down into key concepts, one of which is the disposition effect. This in turn can be broken down into subcomponents that depend on what the investor bought the share price for, the original purchase price. The two underlying components are regret aversion if the investor is in a winning position or the purchase price is less than the average market price, and loss aversion if the investor is in a losing position or the purchase price is greater than the market price. Their behavior changes depending on this context. The RAG may also seek information on the client segment and demographics, and also current market conditions, as well as published literature sources on these psychological effects, as well as how to minimize these effects. This last bit is important. As a financial advisor, you may have studied for many years in a behavioral finance course, perhaps your degree, but this information may be outdated. Using LLMs always ensures you have current and relevant research and techniques where they are available and published, of course. Next is retrieval. On your screens in the top right are the knowledge sources. This is where you store the databases on your specific clients and segments and any research you may have conducted. These could be internal studies in your clients, which clients have shown this behavior and what the results were in that specific case. This information can be stored as a vector database, which basically makes text readable by the algorithm and also chunks data up into smaller sections, making it easy to find the relevant information. An improvement in this is a knowledge graph, which we'll discuss shortly, that connects concepts in a type of mind map. Next, the system will rank everything retrieved in respect of relevance and then send this to the base LLM like GPT-4. It may also augment or add a prompt to the original query. This process is shown in the bottom half of the diagram. For example, the new query enhanced with context to GPT-4 might be, what product should be recommended for a Generation S client in a loss position who is loss averse in a market downturn? This is an augmented prompt created by the RAG to the base LLM. The base LLM takes the new augmented query and combines it with the retrieved information to generate the comprehensive contextual response. For example, GPT-4 doesn't know that Gen X clients have a high disposition effect, but our own database with our own research does. GPT-4 does, however, understand what products to recommend for loss-averse clients in a loss position based on published research. This is the combination of our RAG together with the large language model that shows the power of this combination. It is also important to note that RAGs may also be enhanced with advanced hallucination detection and citation verification. We've already seen some recent examples where lawyers have been caught out citing non-existent case law, for example. RAGs can minimize these errors. On your screens is a knowledge graph that resembles a mind map. I'm sure most of you have used a mind map to organize and structure information at some point in a learning task like passing an exam, for example. The knowledge graph here is organizing information on the relationships between the nodes of personality traits, risk tolerance, and financial behaviors. The green nodes at the bottom are the knowledge sources, while the interconnections show how strong these relationships are. For example, literature will show a strong relationship between conscientiousness and savings behavior. The trait reveals, amongst other things, a person's degree of impulsivity versus impulse control. High impulsivity or not thinking of future consequences equals lower savings rates, and there is a strong correlation or orange line to show this. We now improve this knowledge graph generated by the base LLM by adding our own insights. You can imagine how complex this becomes when we add more layers like money attitudes and secondary client databases we have. For example, earlier I mentioned that we have studied money prudence and conscientiousness among other money attitudes and traits that underpin early pension or what we call two-part withdrawals. We now add this to the knowledge graph. The connecting lines are orange because the R-squared statistic we have calculated between conscientiousness and prudence is 0.92, and between prudence and two-part withdrawals is 0.60, indicating a very strong relationship respectively to this specific context. Next, we have money anxiety that is strongly correlated to neuroticism with an R-squared statistic of 0.92 and more strongly related to two-part withdrawals with an R-squared statistic of 0.75. But we also need to add the weaker relationships as well between the financial behavior and other personality traits. And so the knowledge graph becomes more and more complex, but it maintains a very specific structure of financial behavior and traits that improves the performance of the RAG as it searches for contextually relevant information. Remember, this is all about getting the right information to the RAG at the right time. I've generated the summary of financial behaviors that is underpinned by literature simply to show how these databases can be converted to knowledge graphs over time with testing and experimentation. For example, the trait of openness refers to the person's innate curiosity. They should therefore be, in theory, early adopters and respond favorably to things like cryptocurrency and non-conventional asset classes. That would be very relevant if your firm sells fintech or is a cryptocurrency trading platform, for example, but also for a traditional stock brokerage where technology stocks are available. The strength of this relationship would need to be tested and verified, but there are many more clues and connections here. Those traders, for example, with high openness, who are also extroverts, will likely seek their trading recommendations not from your firm, but from their peers. They may prefer a social or copy trading platform for verification, but will also likely seek status or some kind of leaderboard that could inform a gamification strategy, for example. This shows how a fairly flat or two-dimensional database can be converted to a knowledge graph where more connections are generated between different traits and behaviors, again, making things faster for the LLM. This is where the science and behavioral science comes in, constant testing and verification of these published relationships. Let's move into even the more practical side of the presentation. This deck is available in the download section if you'd like more information on the different behaviors linked to personality traits on this specific slide. From here on, we'll deal with information based on real client that comes from our working RAG prototype to generate contextual information, context for advisors. Let's call it Candace. The RAG auto-populates this content based on importing the results from our Momentum Money fingerprints that diagnoses important dimensions of Candace's risk behavior, money attitudes, and personality traits. Firstly, we look at her risk behavior. I'm going to focus on the red tiles here. Candace has low confidence in her ability to make financial decisions, low financial market knowledge, and this has had a bad experience, or rather she's had a bad experience in financial markets before. She has also switched her investments before when markets have declined in value. We would expect these connections, and based on published literature, the RAG has already identified these as possible warning signs. The relationship between these characteristics and the behavior tax are currently being tested. Next, we look at Candace's money attitudes. The warning indicator here is her level of money anxiety. This is the extent to which money is a source of worry for her. This also appears to correspond with her risk behavior in the previous section. Worry or anxiety isn't pleasant, so we'll minimize this usually by trying to take action. This could be calling the advisor or deciding to execute a switch transaction, for example. Finally, we have Candace's personality traits. Her medium level of risk composure here is also telling and indicative of an action-oriented bias that needs to be tested. The important thing here is that the RAG is correctly identifying potential problem areas rather. On the back end, the knowledge sources are now also connected, and Candace could, for example, be flagged as a potential risk for two-part withdrawals, but also run across different databases where her trading behavior is analyzed as well. This is going to be discussed shortly. Once the advisor's basis has completed or client base has completed these psychometric assessments, the RAG imports all the reports and auto-segments their clients based on any of the individual or number of these attributes like risk behavior, money attitudes, or personality traits the advisor selects. The video starts off with examining the client's composure. These have already been linked to early pension withdrawals. These clients as a group should be targeted with a specific communication strategy to prevent this behavior, like creating focus on what matters to these clients in the future. Things, for example, like traveling with friends and family in retirement, or having the means to do so, or making the client aware of trading off these experiences against short-term consumption. Is it really worth it to buy whatever you want to buy now instead of having those experiences in your retirement? If the advisor doesn't know what the client's dreams and nightmares are, they should make a point to find out. Next, these clients who have had bad experiences in markets could be targeted to unpack this more. Next, we see clients with low financial market knowledge like Candace. Clients with low confidence and low knowledge will also have low conviction. Because they don't have much experience or knowledge, they also are less likely to brush off a market event as normal and won't necessarily know that recovery is also normal. There are many techniques in financial psychology that are aimed at building conviction. Finally, the clients that show relatively low money prudence, these clients would likely need attention in their day-to-day money management, as impulsive spending is likely to pose a big challenge to them specifically. The advisor can now generate content to manage these behaviors or even prompt the RAG to design or recommend interventions targeted at these specific client groups. The RAG is now able to generate secondary data or data not explicitly provided as an input. It categorizes Candace as a moderate to high risk in respect of her behavior attacks, as well as being loss averse. The green box that has just popped up now shows some of the inputs, and then underneath the RAG indicator is shown from the system where Candace is categorized. Again, cross-referencing this with other databases is also possible now, and this is where we head to next. As it turns out, Candace also has a relatively high disposition effect. Remember, this is a combination of loss aversion and regret aversion, depending on whether she is winning or losing. The video shows that the advisor, when logged into his or her client portal, could also use this to get some guidance for Candace. In this case, the RAG is set up to provide an advice link and product link where possible in this order of priority. The output shows that the RAG is advising clear entry and exit strategies for Candace's stock trading. This means relying on rules over emotions. When a stock is rising, take profit levels should be clearly defined and identified, and so rising prices are ignored until these levels are reached that then prompt action. This will discourage more frequent trading and should reduce her disposition effect. On the downside, Candace agrees beforehand for her acceptable loss levels. Her stop loss order can help her automatically exit the position when the loss level is breached. This content, if executed, could then also be exported to the record of advice if appropriate. The sources for this content are also readily available, but as mentioned earlier, hallucination is rare in RAG models and sources are also verified. Next, we get into a more detailed example to make it really specific to Candace. The advisor can also ask exactly what stop level is appropriate for Candace. If the knowledge sources include information on Candace's risk preference, the advisor can get even more specific guidance on the appropriate stop loss level that is matched to her risk attitude. The content generated in this case identifies her risk preference and makes the recommendation specific to this information. The tile below the content generated is from the advisor's dashboard and confirms Candace's risk preference, which is recorded from the money fingerprint. Clients with a lower risk preference would clearly prefer to limit losses more and so have a tighter stop loss level. The highlighted reg box confirms that according to her risk preference, she should use a tighter stop loss of between 5 and 10% of the purchase price. So if she bought a stock for $100, her stop loss level should be between $90 and $95. Finally, the advisor can also get more tailored guidance on other potential pitfalls for Candace and what to do about them. The example shows a prompt about Candace's most dangerous bias and asks for some advice on how to deal with it. The content generated refers to her money anxiety and composure specifically and relates this to loss aversion. Her lower risk preference may also lead to her overly conservative investment strategy over time. This could be a really powerful development. If APIs to market performance are now connected to the RAG, it could easily provide contextual information here. For example, the cost of her conservative investment strategy over time. Perhaps Candace is struggling with deploying her excess cash into markets because she is anxious. Structured investments can now also come into play, providing capital protection while giving her exposure to market upside. The power of these tools increases more and more as more data sources are available and plugged into them. And again, with open banking coming soon to South Africa, the possibilities here become even more vast. The screenshots next to the content simply match the knowledge source from the RAG to the content generated for Candace specifically. These were also shown earlier. This slide gradually reveals a summary of the back-end information we have on Candace that adds a tremendous amount of contextual information. The back-end database also contains information on Candace's behavioral archetype from her investment behavior on the Momentum Wealth platform in this case. Candace is an anxious investor and tends to de-risk her portfolio in market turbulence. The switch prediction algorithm identifies that Candace's switch history, or the fact that she has switched before, places her at risk of perpetuating this behavior. In other words, doing it again. Our predictive algorithm that used a random forest algorithm of more than 20 million observations confirms that previous switch behavior means Candace will be more likely to continue this behavior. Furthermore, as her portfolio approaches and exceeds the 300,000 Rand level, she will be at even greater risk. Candace has a low risk tolerance and she is highly loss averse. She also tends to take action when markets move against her in de-risking her portfolio. This also results in a higher behavior tax, and so Candace needs more help, attention, and guidance with her investments. Finally, Candace is rather curious and likes a lot of detail. She will likely take the time to go through information provided to her, but lacks the financial market knowledge and confidence to build conviction, and so will likely appreciate some more form of knowledge or upskilling to build this resilience. Her curiosity means she would likely appreciate this additional effort on the part of the advisor. These insights show that the contextual information is valuable, not just in respect of client financial behavior, but also in respect of how and when we communicate with the client and what products or solutions they'll likely be on the lookout for. RAGs are already being used in many different contexts and across organizations. For example, they were used at the Stanford Medical Center, where the RAG is given access to patient records and medical literature to assist the doctors' treatment planning and develop more personalized treatment plans for their patients. They're being used in the NBA to analyze the basketball shot patterns and styles and input into coaching programs, and in many, many more situations. Hopefully, the examples shown today will have convinced you that they are perfectly suited to the behavioral sciences to add much more needed personal context in behavioral mapping and predictive behavioral modeling. For example, they might predict that a person with high openness but low conscientiousness will respond better to novel gamified approaches to habit formation rather than structured routine-based methods. We are still in the early phases of testing, with the next step being studying how effective these engagements are in managing behavior. But RAGs can also generate automatic prompts. For example, if plugged into market data when markets are breaking records on the upside or the downside, these prompts can be automatic. Content can be automatically generated and delivered to an advisor's nudge dashboard. And this is all the information there is already segmented and tailored to each specific client. The advisor can then simply select which to execute and which not to execute. Supplementing these databases with social media data and even biometric data from wearables can become more useful. For example, BMI has been shown to be a reliable predictor of longevity, which could be useful when a financial advisor is deciding on whether to use a living annuity or a life annuity. This is just the tip of the iceberg and clearly shows that these methodologies will impact the scientific method itself, where interventions are tested on populations that are more likely to respond to them and not simply against the average population. The future is already here. Thank you.